Did you know that over 80% of trades can occur outside of normal trading hours? Opportunity doesn't wait. Trade more than 70 key US shares 16 hours a day this earnings season.
Love it or loathe it, as an investor, you simply can't ignore it. Digital currencies, blockchain, smart contracts, NFTs, Web3 and more. We want to understand and explain the entire ecosystem, which is evolving by the day. We'll talk to the developers and investors in the ecosystem to find out where the opportunities are. Join me for Cracking Crypto, weekdays only on ausbiz.
Cracking Crypto is partnered with City Index. Trade shares, CFDs, Forex, crypto and more with a trusted provider.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Hello everybody, welcome to Friday here on ausbiz. Great to have your company as we kick off the afternoon with The Call as usual. 10 stocks suggested by you. I chuck in a stock of the day. I put them to our expert panel for their adjudication. All happens in 60 minutes. It's a lot of fun, very informative, and our panels are always spectacular. This one is no different. Claude Walker from A Rich Life. Claude, welcome. Good to see you again.
Thanks for having me, David. Good to see you too.
And Luke Winchester from Merewether Capital in Newcastle, the micro-cap guru. He even has a lot of our viewers asking specific questions to him at the moment. We've got a few. Mate, good to see you on this Friday.
Thanks, Kochie. Yeah, no, good. A good few micro caps to discuss. So, can't wait to get into it.
I know. Well, first half of the call today, we'll be taking a look at Stealth Global, Spirit Technology, Arizona Lithium, Riversum, and Adore Beauty. But let's go to the other extreme of the microcap for stock of the day. Thought we'd take a look at REA Group after they're reporting a bumper 37% increase in half-year revenues. More to come as 2022 promises to be another big year for the online property group. Shareholders will get a very healthy 75 cent per share dividend, despite management expecting an increase in operating costs. Company also targeting full year positive operating revenues and also including Mortgage Choice in their armory as well. Stock's down a touch today. Came out on the day that News Corp reported pretty decent results as well. Claude, what do you think of REA's result in these COVID times? Property has been on a tear, has been hot. I suppose it's been a beneficiary.
Yeah, I guess it has been. And I thought the result was actually really quite strong. And I was a little bit surprised to see that the stock didn't move. Perhaps, I thought it might be up a little bit on the result, to be quite honest, even though this is a much larger company than I usually invest in myself. I don't invest in a mega cap like this one, but it is a high quality blue chip business that has a identifiable moat that should be durable for many years. And it has presented what I understand to be quite strong results. Even I thought it was a touch above what the analysts were expecting. So usually for a large company like this, I would have actually thought to see it notch up, but perhaps it's fighting against the fact that I guess growth stocks and high multiple growth stocks have really been coming down a lot lately due to inflation fears. So, you know, on the one hand, you have great, strong underlying performance. You know, from what I've read so far of this result, I haven't obviously had a long time to analyze it, but I think it looks really strong. This has been a strong business for many years. This was another strong result. The underlying business seems very healthy, seems to be going very well. But of course, share prices will go a little bit too far to the upside and then a bit too far to the downside. So maybe what we're, you know, seeing now, the bigger picture is that perhaps the share price got a little bit ahead of itself, and now its fundamentals might have some work to do just to catch up, to bring the share price back up.
Would you be a buyer at these levels?
So obviously for me, I prefer high risk reward small caps, but yeah, look, I do actually think that REA Group is probably something reasonable to buy in a diversified blue chip oriented portfolio. Yeah.
Okay. Luke, what do you reckon? See, my fear of this was the property market was too hot. They make their money not only just on people listing their property, but paying a premium for the position they get and the length of time that they have on the platform, which I thought, gee, everyone's flogging their property pretty easily. Why would you pay a premium? And the listings won't be there on for a while. So it actually did a whole lot better than I thought.
Yeah, look, Kochie, I agree. And that was my fear with REA sort of last time I looked at it a few months ago. I sort of questioned, where's the growth in the business? Because you outline those drivers. It's listings growth and sort of the additional revenue they can generate by shifting people to what they call their premier options. And it seemed like listings growth, you know, we'd had a hot market and maybe we would be in that sort of, 5 to 10% listings growth. It looked like REA as a business had gotten pretty close to tapping out that premier conversion as well. That was up around like 85, 90%. And then they come out with this result, and listings growth is obviously 17%, which I think is above normal and maybe where you see a bit of apprehension in the share price. People expecting this could be a little bit of an over-earning sort of report. But fair play to the business. That's out of their control. What is in their control is they then generated even more of that conversion to Premier, just as you think maybe that's starting to top out. So you go from 17% listings growth to 25% organic growth as you generate that additional extra. Always been a brilliant business at managing the cost base, so you saw leverage all the way through to earnings. Valuation's the only thing you can sort of point to as a potential negative or something that sort of goes against just owning this stock or buying this stock outright. It's right up there, 55 times earnings, and like I said, there's a chance that those earnings could be a little bit elevated given the macro we're in with housing, and does that start to just cool down a little bit? I probably agree with Claude, though, for the right investor, and this isn't me or Claude, we both outlined that, we focus more on that smaller end of the market, but if you're someone who just wants a sleep at night portfolio, like REA, and I think even being down a little bit today, Claude touched on it perfectly there. It's just the fundamentals backfilling where that price has gone, probably post-COVID. So I think it's a buy as well for the right person who understands that it probably won't give you, 35, 40, 50% a year. It did that coming out of COVID. Now it maybe consolidates to a more steady income. But it's such a quality business. I think you can definitely own it for the longer term.
I love the way how you two do that because, it's not in your wheelhouse, but you can understand every investor has a different wheelhouse. So for a blue chip, good sort of self-managed super fund, low risk, maybe it's appropriate for it. So it's good to distinguish that. All right, let's go the other extreme now. And Luke, a viewer wants a view on Stealth Global Holdings. Now it's in it's just a supplier of safety equipment, clothing, tools to business, isn't it?
Yeah, so it's a distributor of safety equipment, workwear, tools, things like that for
based in Perth.
Based over in Perth, yeah. So distribution business, these businesses are really ones about scale. You usually have a pretty high fixed cost base to the business, very low margin, but you're looking to do a lot of revenue. And as you tick over a lot of revenue to a very low margin base, you can still get some good absolute returns. And the poster child of distribution businesses on the ASX is Dicker Data. That's the example of what a good distribution business can look like over many, many years. Most of them aren't that good, and Stealth Global probably won't be, because it's particularly a physical distribution business, whereas Dicker Data can move into that digital distribution. But look, 12 mil market cap, 13 mil market cap, it looks like this business is starting to get that scale behind it where it becomes a very serious player in that distribution space. Admittedly, that's been acquisition driven, which is why you haven't seen it entirely in the share price, because there's been dilution for shareholders along that way. But they're creeping up towards 100 mil revenue run rate, targeting 6% EBITDA margins. So you're talking about sort of a run rate of maybe 2 times EBITDA. Management have some initiatives to try and grow that to 8% over time. One thing I found very interesting, and this is a business I've sort of had on my watch list for a while, I don't actually own it. They made an interesting acquisition a few weeks ago of a business called United Tools, which is, my best understanding is it's a bit of akin to a Metcash to IGAs. So it's not actually a retail business in and of itself, but it supplies as a cooperative to independent, locally owned tool retail outlets. And it was a very interesting acquisition. They only paid $24,000 for it, have an ongoing marketing commitment, but that ongoing marketing commitment was covered by net cash that they acquired. So I found that very interesting. Would like to get more details. Management have said they're going to do a video conference actually next Tuesday. So I encourage, I don't actually have the name of the viewer, I encourage, if anyone's interested, tune into that, get a bit more detail around that acquisition, because it could be very interesting, but I just need to know more about it. Otherwise, this one, well and truly on my watch list. I think it looks really cheap. I just need to see a little bit more of that execution before I jump in.
All right, so not at the moment, but on the watch list. Claude, what do you think of Stealth?
Well, I think Luke's done a very good job there covering a few of the issues. I also noted this sort of strange acquisition that appears to be a very, very cheap price. My guess is that the reason for that is that actually the thing they've acquired loses money after all said and done. So that's why it's sort of been almost perhaps given away to them. But I don't understand that properly. But what I did note is that to add on to what Luke was saying, we've covered why distribution businesses can sometimes be successful. I'd like to combine that with the idea that at least it makes sense to do a roll-up in a distribution business, because sometimes when you're just rolling up businesses, it's sort of just multiple arbitrage. You're trying to take advantage of the fact that you can buy a business more cheaply in the private market than what it trades at in the public market. But at least with distribution roll-ups, you're actually changing the nature of the business, because as you can imagine, the quality of distribution network has to do in some parts with its size. That basically, there's an additional expense in being able to distribute to a certain area. But then once you have that part of the network in place, the more volume you can put over that fixed cost, essentially the higher margins you can make. And that's there, as Luke touched on, their specific goal is to increase the margins. At the moment, the reason they're probably so cheap is that you would sort of, they're talking about underlying a bit the margins at this sort of thing. And because of all the acquisitions, it's sort of very difficult to get a true read on their profitability. Having said that, I love that we started with this one, and I love that this one got written in, because this is actually the kind of microcap stock that I think can be interesting. I would basically want to see a little bit more track record for them, because one of the disadvantages of being a small distributor is that the need to sort of fund inventory and that kind of thing can mean there's a lot of demand on capital. And when you're quite small, that can be sometimes more difficult to satisfy. So definitely one to watch. For me, I guess I would call it a hold, but I have to say it's definitely on the top of my watch list after looking at it today. And I'll finally close with the fact that at the AGM, the chairman said he had extreme confidence in robust financial results into the future. So, if that proves to be justified, it'll be good.
All right, watch list for both of you. Phil wants a view, Claude, on Spirit Technology. Phil's in it, has hit an 18-month low. Revenue's up 14% in the last quarter, says Phil, but it hasn't been able to translate into EBITDA growth. They also didn't mention any cash flows, according to Phil in the latest update, which may be a red flag that they're burning cash, some pretty attractive multiples. Phil says, I'm torn between selling and topping up. Phil, I love the question. Spirit is a telco, internet, cloud solutions, telephony in Sydney, Melbourne, Brisbane and the Gold Coast. What do you reckon of Spirit and Phil's question? Top up or get out?
Well, to take them in reverse order, I think the question is excellent, and it's so awesome that viewers are getting into the weeds here and really thinking about things. Look, I would say that the most important thing is I think he has the right idea that you need to look lower than the revenue line for this kind of business. Now, Spirit Technology is an interesting story. Actually, a few years ago, I was actually a shareholder of this and liked the stock, but at that stage, it was more focused on building out a fixed wireless telecommunications network and a high-speed retail telco. And they're actually parts of the business. It's just undergone this massive transition in the last couple of years where it's actually sold its consumer internet stuff. It's looking to sell that original broadband network that I was or the wireless network that I was interested in. Meantime, it's made a huge number of acquisitions. I won't name them all here, but I guess the important thing to remember is that a lot of those acquisitions were done at a share price that was higher than the current share price. So for whatever reason, the Spirit share price really got a bit of a boost last year. And as you can see, it got up to about 40 cents or even higher. And the company sort of used this to issue in 2020 a fair few shares at various prices, like 32 cents, 33 cents, 35 cents. Like it just went on and on, right? And that capital was used to essentially roll up a bunch of what I would call loosely like IT services companies. And now these businesses tend to be a little bit lumpier. So because they're more contract-based or project-based, it's not like recurring, reliable revenue. And what you've seen in their most recent update, which is probably what's been pushing the share price down more, is that their underlying EBITDA is actually down, which they say, has to do with basically COVID disrupting some of their business. But I would say that the fact that, that makes their EBITDA goes down, it sort of shows you that arguably the quality of this business has gone is not that brilliant. Right. And so it could be a bumpy road. When things go well, earnings might look great. But to me, this business is not super high quality. So I would say a hold at best. I would not be topping up. And I don't hold the stock myself.
Okay. What do you reckon, Luke?
Yeah, look, I think it's good Claude's given that background to the business. It's one that, obviously being a micro cap, I've sort of tracked on and off, but never been that close to it and never owned it like Claude has. Because one of my things I jotted down looking at it was I just couldn't see a coherent strategy with the business. As Claude noted, you sort of used to do some retail ISP stuff, some fixed wireless. That's now being spun off. You've moved into cybersecurity, and I just sort of wondered where does this business end up, and there may be a coherent strategy there, and it just takes time to get to it. But from the outside looking in, it was one of the things I did note. Phil was spot on. The margins is the main issue here, and I think that's the weakness in the share price. And the problem I saw is they're not improving. Like first quarter to second quarter 22 went from 6.5% to 6.2. So the narrative in the presentations is shifting to a more recurring, higher margin business, but that narrative's not matching the underlying numbers coming through. So for me, look, Phil, I like Claude, I wouldn't top up. I definitely wouldn't top up unless you have conviction in the stock, which I don't think you have, just based on the question you've sent in. Whether you keep holding it, you probably know it a bit better than me, but I think there are concerns there. And go back to something Claude said about stealth, and businesses just rolling up almost for the sake of rolling up. Spirit probably is closer to that end of the spectrum than a genuine, roll up that's getting synergy benefits across everything they're doing. So, not one I would have high conviction in. I'll probably say hold just because I don't know enough to say a sell. Okay.
All right. Luke, Sarah wants a view on Arizona Lithium. Yep, there's that word lithium, and of course it's at a 52-week high, as they all seem to be at the moment. Its projects, though, are exploring lithium projects in the US, Big Sandy, Devil's Canyon, Lone Pine. It's almost like watching a Western, isn't it? What do you think of Arizona Lithium?
Yeah, well, full credit to management. The name pretty much explains the stock in 2 words. It's lithium over in Arizona. It's very, very early stage. And, even for me, I'm not big on mining in general, let alone these sort of pre-producers. I can't even add much, to be honest. Kochie. Like, there's such a long way for production. They haven't even done their pre-feasibility study yet. There could be something there. There may not be. Look, one thing I would say is that the location's interesting. You're very close to Tesla's Gigafactory over there in Nevada, obviously being in Arizona. So that's interesting. If I wanted exposure to lithium, I would go for a producer. Even though I think they are expensive at the minute, I would look at a Pilbara, an Allchem, even a Mineral Resources. Even though you're primarily iron ore, you get some good lithium exposure. It's just not for me, this sort of speculation. I think Gaurav, who comes on, he talks about lithium being a very difficult to mine and produce material. So there's also that sort of risks with something so early stage.
Yep. Claude?
I won't add much to that other than to mention that they did raise capital at just like about half the current share price not that long ago. And with that was options exercisable at 12 cents. So to me, there's probably I would say I'm looking at this as a narrative right now. I don't think there's a valuation story that I can add to here. And I don't think that's what's driving the share price. There's a narrative, supply and demand, hype or fear. And there's probably a lot of shares that people that have bought shares recently that's sitting in profit. So when it does reverse, when the momentum changes, it could be quite sudden, but I wouldn't know when that is. But for me, it's definitely not for me.
Okay. Luke, Matt wants a view on Riversum. This is a silicon chip technology manufacturer, isn't it? Or research group. It's going for a single wafer processing unit, sort of that new technology?
Yeah, I must admit the technology probably escapes me a little bit, but this is one I chucked on my watch list either last round of reporting or last quarterly. The main reason why I like to sort of keep an eye on situations like this where this came to market a couple of years ago, was growing revenue very fast, was also very heavy losses. And you're in a market that was good for that. And as long as the growth was strong, the market would reward you and you're probably able to raise capital at higher prices and continue to grow. You obviously get a hit with COVID and some issues. And what I always like to see is at that point, a management team start to make some hard decisions about their cost base. And that's what Riversum did. And their annualized cost base has come from about 13 million all the way down to about 10. Revenues are starting to pick up as they've got a backlog to work into, and they're sort of aiming for cash flow profitability in FY22. And I think they're on a calendar year. They're a US-based company.
Yes.
So it's on my watch list. If they've given a very wide range of guidance, 25 to 30 mil USD. If they come in sort of mid-range of that guidance, on my rough numbers, I think they're roughly break even. Obviously, they come in at the upper end of that guidance. You might be doing 2 or 3 mil profit on a 100 mil market cap. It starts to, expensive but interesting for the product and the growth they could do. Obviously, if they come in at the lower end of that, then they probably missed that guidance of break even they were looking for. And my one note is they also had some guidance for FY21, which they came in at the lower end of. So I just don't know if I'm ready to step up and fully just back management yet to, hit numbers at the higher end or upgrade or whatever. I just need to see a little bit more. It is on my watch list though, Matt, for that reason. I like to see management teams make those hard decisions and recognise that, okay, previously we relied on the market for capital when we needed it. Let's become a self-sustaining business and not through top line growth, but through making hard decisions to the cost base. Yeah. So it is on my watch list. It is that nice micro cap. The tech escapes me. I'd have to do a bit more work around the tech, but that looks interesting and genuine contracts, orders, revenues coming through. So I'd say hold if you're there, Matt, and for anyone else, chuck it on your watch list. It is an interesting little business.
Okay. Claude?
Well, Luke's done such a good job again. I agree with his conclusion there. I would note in favor of the company a couple of things that make me think that it's actually one of the better little speculative microcaps we get to talk about is that basically in its most recent quarter it managed to get operating cash flow or very close to operating cash flow break even, so just an outflow of 330,000 and supposedly the receipts from customers do tend to lag those revenues a bit. So that is interesting because it's partly what it says about management, as Luke was saying, but also just because that cash flow break-even part can be an inflection point when a new type of investor starts to get interested in the stock. And if we think about, because this is obviously partly a narrative-based stock as well, right? Yeah. But if we think about the sociology of markets, as you get to the milestone as cash flow break-even, you open the doors to another new type of small cap investor, more such as Luke and myself. So that can be a positive time to watch a company. That can be a positive time to even consider buying. So that's what I think is most interesting about it. But we'll have to wait and see whether they get over that line in the next few quarters.
Okay, hold from both of you, but on your watch list. Hannah wants a view, Claude, on Adore Beauty. Hasn't been listed for that long, only about a year and a half, I think. A pure play online beauty retailer, listed with a bang, then fell down to earth a bit and recovered. What do you think of Adore?
Well, I'm going to take that same angle that I feel like is almost a bit of the theme that I wanted to talk about this show, which is that Adore Beauty, even though it has like genuine revenues and is an absolutely real business, this, when it was listed, it was absolutely, in my view, a narrative-based company. So basically, you know, it's this amazing story, like a startup in Australia run by women for women kind of thing. And there was heaps of excitement. And I think, you know, what happens is when you have heaps of excitement around a company, it just gets tending to get overvalued, basically, and the expectations are really high. Now, sometimes, very, very rarely, sometimes these narrative stories really pay off, right? So the people that jumped on the Afterpay narrative early, they got their massive win out of that. But if you're going to do narrative style investing, i.e. jump on the Adore Beauty 6 months after its IPO, when it, you know, obviously it's had this big bump into e-commerce, massive advantage from COVID, all of that. There's hype, there's excitement. What you're doing there mostly is, in my opinion, that is a largely narrative investing. And with narrative investing, you're going to have very occasionally the narrative investing works and the narrative gets matched by reality and whoa, off we go. But a lot of the time, the narrative won't, like, it turns out, in my opinion, it's probably likely that Adore Beauty is, you know, has a bit of brand value, but it's mostly just like any other e-commerce retailer. And so it shouldn't be trading much more expensive than all the other retailers, basically. And if that's true, that's why we're going to see the share price go down and languish. So that's the risk with narrative investing. Sometimes it pays off, but to me, this is still a narrative investing. It hasn't fully broken the narrative yet, but I think there's a fair risk that the narrative could break, and I'd be more interested in buying it after that.
Okay. All right, so no for you. Luke, what do you think of Adore?
Yeah, look, that's good context from Claude. And I guess, you know, digging into it a bit more, talking about narratives and sentiment, you've also seen that pivot with these businesses and e-commerce, high growth tech, you know, more speculative business models. The pivot has come from the market purely just rewarding revenue growth, which these businesses were giving you in spades, to now wanting to see, if not profits, at least signs that you can be a sustainable business that may scale into being a very profitable one in the future. So, you know, like Sequoia came out yesterday and was off 20% on what 1 year ago would have been a result that probably would have seen them up 20%, you know, tripled their revenue, but at the price of costs really blowing out. And I think what's happened to e-commerce over the last, call it probably year, because we had that initial COVID bump, is the market slowly realizing that it's probably not right to price these businesses like SaaS technology businesses. Even though you can run a long-term value to cost of customer acquisition analysis on these guys, because, you know, you do get return customers, churn, you know, order sizes, all that. You get all the metrics you need to calculate it. I think what that analysis lacks is returning customers often need to be won again. So just because I bought with Adore Beauty once doesn't mean I'll automatically return there to buy through them again. If I'm prompted with the right piece of advertising at the right time, I may come back to them and I get registered as a returning customer, but they've had to spend that marketing to get me back. And that's different from a true SaaS business where once I'm on, I'm just paying my subscription and I'm in there. And I think that's where Amazon, you know, everything gets compared to Amazon, I know, but the subscription model of Amazon is what sets them apart as an e-commerce retailer from everybody else. And so Sequoia, Redbubble, Kogan, you've seen it in all their results so far, and Adore Beauty will be out soon, I think on the 15th I read. I think you'll see the same thing. That cost of acquisition has just skyrocketed for these businesses as they're trying to maintain the growth, and the market's just looking past that. So I think the business actually looks really interesting, and one thing I did note is that they are trying to create that Adore Beauty brand, and, you know, they're running podcasts. There's an app that has like education tutorials. They're trying to create, you know, a place where Adore Beauty is more than just an e-commerce retailer. There's something there, and I think it's a business that at the right price I would be interested in owning. I just don't think that price is now. I don't think that sentiment's now. I would probably hold if you're there. I wouldn't buy it at least until you see this next half-year report. I would definitely need to see that before I even thought about stepping in to buy it right now.
And look, we have great retailers in this country, don't we? You look at JB Hi-Fi, and with a mixture of online and foot traffic, you've got to throw these online retailers into that general retail sector, don't you, and see how well they run and the multiples. I think JB Hi-Fi is still only on a multiple of 15 or 16.
Yeah. About a year ago, I actually penned a blog post about physical retail versus online, and I sort of made this point that I found it odd that the physical guys were actually seeing some real tailwinds behind their business, where you had some increased consumer spending, foot traffic was still good in Australia, but the rents they were able to negotiate with these landlords were coming down. You see that Solly Lew at Premier, the hard line he is pushing on rents. Whereas you open up a Redbubble, a Kogan, a Door Beauty, you open up their rent, in inverted commas, is going up. It's the rent they pay to Google and Facebook. Google was up 7-8% the other day. That's where all of the incremental sort of spend is going. And so I found that interesting dynamic a year ago, and that's sort of played out over the market. I agree. I think physical retail, there's things that are moving parts to that, but I'd probably focus there over the e-commerce guys right now anyway.
Yeah, exactly. All right, let's recap the first 5 stocks. Our stock of the day, REA, a buy from both Claude and Luke for blue chip investors as part of a diversified blue chip portfolio. Stealth is on their watch list, but a bit too early for them to get involved. Hold on Spirit, Arizona, Lithium, a no from both. Riversum on the watch list again, and a hold on Adore Beauty from Luke, a no from Claude. Here on the call, we have our own fantasy portfolio. We've been tracking since the 1st of July. Let's see how it's performing. Up for the week, we're up 4.5%, the month down 7%, since the 1st of July 2021, up 3% since inception. On the 1st of July 2020, up 39%. Before we get into our next 5 stocks, a bit of an update on the calls portfolio. On the 1st of March, we'll be launching a brand new portfolio, a live fund that's high conviction, with a much smaller basket of stocks. Now, how's that going to work, you're asking? Well, we'll still be taking your requests and covering 11 stocks every day. It doesn't change. Asking our expert panel for a buy, hold or sell on them all. So consider that the first filter. If the stock gets a unanimous buy or sell recommendation, it goes through to the investment committee, which will meet monthly. That committee will decide whether to add or remove stocks from the fund, and look at things like changing the weightings and the like. The whole point of this is to give you more insights into how experts think about portfolio construction. So each month there will be an extra edition of the call where we take you inside the investment committee's meeting. You'll see how the fund's tweaked, how the investment committee thinks about all the information and the decision making. For example, if they have an issue on a particular company, we might bring in the company's CEO to answer to the investment committee some of their questions on whether it should be in the portfolio. So keep sending in your requests. Current portfolio will stay as it is until the end of February, and then we'll unveil the initial fund on the 1st of March. So it's going to be an interesting extra step, I reckon, in the development of the call and what we do here each day, and also the fantasy portfolio. Coming up in this half hour of the call, we're going to take a look at Quorum, Delorean, Sequoia Financial, Firebrick Pharma, a new listing, only about a week old, and Gnosis. So let's kick it off with Quorum. And Claude, I think you've got an interest in Quorum. You know about this pretty closely, a software development company that is focused on pharmacies.
Yeah, that's right, David. So I own shares in this one. It's actually not, it's a bit of a turnaround story. So it's not a great quality business as we speak right now. But what it does have is, the potential to be a great quality business, because what it does is it provides software to pharmacies, many around Australia, and also connects them with their ordering of various pharmaceutical products. So connects them between distributing companies that distribute products into pharmacies and the pharmacies then ordering those products. Now, obviously the reason that I like it is because when they're run well and they're growing, these software companies can be very sticky, and it certainly is sticky, right? But it's just not growing. And so as a result of that, if we put it really simply, because it's not growing, it trades on less than 4 times its healthcare software revenue. But even though it has, it made a small profit, and its cash flow, sustaining, it has over $6 million cash in the bank. It's not in any threat of going out of business, but it's just not growing. So it has that super low multiple. And that the management needs to go in there and turn it around and get it growing. And the bad news is that the CEO that was doing that has just recently resigned from the company. And, obviously that's right before the next results getting released in February. So that makes me think that the February results might be not very pleasing and may not show the growth that we're looking for. And in which case, the short-term prognosis for this stock is, the share price is likely to go down a little bit if that's the case in those results. Having said that, I'm not selling my shares. I'm holding on to my shares. I could actually even see myself buying more shares if the result is actually decent and the share price goes down. I still like this long term and I still hold it, but the problem is these turnarounds take a few years because the software previously was not significantly kept up to date. It wasn't worked on properly. So it's quite a lot of work to go and refresh all of that software, make it better, and then get to the job of selling it and getting the growth going and winning market share again. And they're not there yet. Obviously, if it does become a growing software stock that's profitable, it's going to have a way higher multiple of revenue than it currently has, I think. But it's just not there yet. So that's the risk.
All right, a hold and you might top up. Luke?
Yeah, look, Claude outlined the product and everything very well. He owns the business and knows it. I thought it's a very interesting one. And as Claude pointed out, I don't own it, but I've had it on my watch list for a while. And you sort of just wait for these turnarounds, and they always take a little bit longer than what you hope or expect. And, there's always sort of 2 steps forward, 1 step back and things like that. So it's about 40 mil market cap. Last year did, 2.2 mil profit. So it's not crazy expensive, about 18, 19 times earnings. First quarter, that core healthcare software, I think Claude maybe sold them a bit short. They did 11% growth. It's not, not hyper growth, but it's something.
He's always been a hard marker.
Yeah. Well, sometimes you are if your stocks you own. Like, you're more likely to be harsher on them than ones you don't. I find that myself. And if those margins maintain, which that's a bit of a question mark, because as Claude said, if you're reinvesting back into your product or into growth, maybe the management have made a decision to sort of sacrifice short-term profits for a bit. But, there is a world where if I'm being generous to this business and sort of say you've got a bit of excess cash on the balance sheet, a bit of growth into FY22, that multiple could be falling down to sort of 15 times earnings, which, that's profit, not revenue. And that's a very sort of market solid multiple for what should be a capital-light business moving forward. So I do all that work and sort of was quite positive on the business and probably leaned towards a buy for the program today. And then I hit what Claude just outlined, the CEO resigning. And when I went back and looked at him coming into the business, he was obviously brought in as a turnaround specialist. So it may not be an immediate red flag. It could well be he thinks that core turnaround of just stabilising the business, getting it back to a cash flow profitable and a self-sustaining business model. He may believe he's done that sort of work, and now it's up for the next person to come in and drive growth. If I could answer that question and maybe, a call to management or the next quarterly, there may be some more information about it, I could definitely, come back and own this. I think sort of just following on to what Claude said, on that next quarterly, it'll shed a lot of light on those issues. So I think I've said this 3 or 4 times now, but definitely watch list this one if you're in that micro cap space.
And hold it.
Profitable, growing. If you're there, hold it. I wouldn't sell it. And definitely keep an eye on it, because if those things aren't as, if that red flag's not as big as what I think, then that's definitely one you can own.
Okay, excellent. Daniel wants a view on Delorean. Daniel, I love this question because you've worked these two out. He goes, I like Claude and Luke's thoughts on Delorean. It's in Luke's wheelhouse. It's a micro end in the market. And because it's ESG, environmental waste management, Claude would be an ally as well. So he knows you two backwards. Daniel says, from what I can see, they were making money prior to coming to the market and now expanding, but I have concerns about having three parts to the business and running all of them well. They collect food and organic waste from industrial and agricultural streams, local markets and the like, and they turn it into biogas, which I can see why he reckons it's in your ESG wheelhouse, Claude. What do you think of Delorean?
Well, he's of course spot on, and I'm absolutely cheering for these guys to succeed, because if they can, basically just do that recycling, they're looking at all the organic waste in Australia and saying, look, there's heaps of organic waste here, and we can make use of it. I would really love to see them succeed, and I could see myself lowering my investment hurdles a little bit to try and get on board this kind of business. But the thing is that actually, so what their sort of core original business is, it was like EPC contracting, which is where, they sign a contract to build, biogas facility for somebody and get them sorted out. And the problem is, as probably the regular viewers would guess, this is just too, what I'm looking for is recurring revenue, sticky customers. It keeps growing, low need for capital, not lumpy risk. I like smooth growth, always upwards. But because it's project based and lumpy, you actually saw in the last report revenues were lower, right? And even though there's this big long-term opportunity for these guys to go and set up a lot of this stuff, the problem is, somebody else needs to have the money and the desire and all the planning approvals and all of this stuff. You need to do all of that to get it up and running. And now, of course, they're going into developing their own kind of projects, which is not a terrible idea, and I wish them every luck. And that may be the key to their eventual profitability. Right. But the problem is they're not there yet. And what I would be looking for is them to have a couple of their own successful projects that are pushing out a more regular profit, and then they would sort of be more getting. That would be a proving out of the business and a de-risking that I'd be looking for. So, for me personally, it just doesn't fit the business quality that I'm looking for. But it could get there one day, and I hope it does. And it's definitely got that long-term tailwind in terms of the fact that it would be better for the planet if we did have more of this sort of system.
Yep. Okay. You had a better expression on your face and explanation. I will never forget when you last time you were on, you analysed Whitehaven coal, and the look on your face, and you said because millennials are going to come and crush them. And crush them in the future. And even I started to get a bit scared when.
Well, David, I have to apologise to one viewer who wrote in to me and said, Claude, it's not just millennials that are coming after them. Some boomers are coming after them too. And I had to say, you know what, ma'am, you're correct.
But the way you went, crush them. It's never want to get on your bad side. Luke, what do you think of Delorean?
This is one I'd actually never looked at. It's a pretty recent listing. Look, I think it's really interesting, and Claude did a good job of outlining that pivot in the strategy. I think that's a good pivot to make. It does sort of change the profile of the business, though, because as Daniel outlined, this was a profitable business while it was private. It's now listed, and that change in strategy to a build, own, operate model. So you're not just building a biomass gas plant for a customer and then off you go. You do that at a lower margin, but you own that plant, you operate that plant, and there's as Claude outlined, this can be a very fantastic business model in the future when you may have a dozen or so of these plants around the country, and you're just clipping that ongoing retail of energy. Look, despite being profitable and sort of investing into the strategy pivot, I don't actually think this business will pivot to a loss-making business. I think profits may be flat, and maybe you're just seeing that churn, in the shareholder base until you see the actual reported growth resume. Yeah. But there was a lot to like the more I look. Founders still own 50% of the business. The former managing director of Tox Free Solutions, who was bought by Cleanaway, he sits on the board. There is a fund who's selling, so you've seen their substantial holding notice twice. So there's, that's probably why you see that chart just sort of capped at around 20 odd cents. Look, I'm keeping this theme. I'm sorry, Kochie, but definitely keep this one on your watch list. Daniel, if you're there, I think you hold it. As Claude says, especially if that sort of ESG investor and you want to be a part of, supporting these businesses, I think definitely hold it. This is one, we all want to see what they're doing grow and succeed into the future. But even from a, shareholder financial point of view, I think there's a lot to support owning this business. It probably takes FY23, FY24 before you see it come through in the numbers, and that's probably the inflection where you see the share price really recover. So sit tight, watch it until then if you're not in there. Definitely hold it if you are, and really love what they're doing.
All right. Thank you, Daniel, for sending that in. Guys, we'll have to pick the pace up a bit. 3 more stocks to go. Running out of time. Haley wants a view, Luke, on Sequoia Financial Group. Again, another one of these investment platforms for accountant superannuation funds. What do you think of Sequoia?
Yeah, these guys, they offer a complete solution around wealth management, insurance, self-managed super funds, quite a legal practice around the administering of self-managed super funds and investment vehicles. It's a very cheap business. Trades on my numbers about 10 times FY22 looking forward a little bit. There's a bit of modest growth assumption in there. Some big targets, targeting 400 mil revenue by 24-25 off a base of 116 million last year. So I'm guessing they're planning on some more acquisitions just to flesh out either geography or maybe product suite. But this is a management team that's proven they can do that. So, I don't sort of negate them for that. One thing I do like about this business, and a few people have highlighted this in the past who I respect as investors, they have a business called Morrison Security, which is a clearinghouse. Now, what value you want to ascribe to that, it's sort of what you do as an investor when you're looking at the balance sheet of a business, but it's a competitor to an Open Markets or a FinClear, which Magellan owns 15% of. So Open Markets looking to IPO, if Magellan does something with that FinClear holding, that might provide a nice little valuation comparison to what Morrison's has got within Sequoia. Right. Okay. I'd actually say buy, Kochie. I think it's nice and cheap. It's growing. The one risk you've got is it's tied to capital markets, which are we going through a period now where markets are choppy? But that could be your opportunity. I think longer term, I like this business and I like this management team.
Claude, you're in it as well?
Yeah, so I do own some shares, and since we're saving on time, I just agree with what Luke said, but I will add, certainly I think that the board, or at least some of the founders of this company are pretty talented in this environment. So for me, it's a little bit of a jockey bet. And then the other thing is that directors have been buying at 67, 68 cents on the market not so long ago. And that sort of could be a signal to me that I was like, I'm still happy with the sort of current price. And so for that reason, I remain bullish at myself. I could see myself buying more of this. It adds a little bit of diversity to my portfolio in the sense that it's a cheaper stock. It's not a high growth hot stock. It's more of a cheaper stock and pays a little dividend too. So I like it. Yeah, this price.
All right. Let's go to Firebrick Pharma. David wants a view on that. Firebrick only listed last week. It's developing a nasal spray called Nasidine for people with colds to try and treat the common colds. The founder of this actually invented the betadine throat gargle. And this is the new product which they floated, IPO'd at 20 cents, got up to 75 cents at one stage. Claude, what do you think of Firebrick?
Yeah, so Firebrick come across my desk, I guess, because people started telling me that it was going to somehow help treat COVID or whatever, and I think that's the sort of hype story that I'm not saying the company's saying that. I'm just saying that I've seen anonymous people on social media saying that, and I don't think that's right. And so I read a bunch of the studies that they were sort of relying on.
It's for the cold, for a cold.
Yeah. And I don't, but it's also not approved. It doesn't have approval for that. It's just the idea of a thing, really. And they're going to do trials, and there's a lot of excitement about that. But I don't think that it's going to be a great solution. The trials, the kind of thing they're talking about is people spraying themselves in the mouth with an antiseptic every 4 hours to get what my non-scientific expert understanding is not a super great advantage in life. So it doesn't have a product there at the moment for sale, and maybe one day it will. I think the other important thing to note is that if you look in your ComSec account or whatever, you might see that its market cap is about $60 million. But what you've got to remember is there's a bunch of escrowed shares that are not yet listed on the market, which that data provider does not show up in the actual account. So actually its market cap is over $90 million when you include all the shares.
Right.
So that could lead some people who are just beginners to make a mistake there on their valuation. To me, it looks very richly valued for a not particularly good story. So I'd say it's probably, in my view, the worst stock that we've discussed today.
Okay. All right. Luke, if the betadine throat gargle was in there, that'd give it some revenue, I should imagine. But it's come from the same founders. What do you think?
Yeah, I'll give you a positive and a negative, Kochie, when I open up the prospectus for this one, because it's obviously only been listed a week. The positive is the two founders continue to own 20% of the business and are escrowed for 2 years. So, they obviously believe what they're doing. The negative was this product has been through clinical trials back in 2019 and failed. I read the prospectus thinking, okay, have they switched the compound or, done something to now bring it to market? And they haven't. And I don't understand that. And maybe they're looking to market this product not as a cure or a prevention for the common cold, but just a, reduction of symptoms like most medication is, a treatment. But that gets down a tricky path where now you're going into the consumer medicine space where you're playing with, other products, big pockets, and distribution into places becomes an issue. So I agree with Claude. I think you've had a good pop on the IPO. I probably wouldn't be rushing into this one. I think they're a long way from where they want to be.
Okay. And our final stock, Luke Phillip wants a view. Is it Gnosis with a silent K? Saying, what's your opinion? It's testing 4 cents. They're aiming for growth and are back cash flow negative last quarter with increased spending. Are you worried about it? This is a question from Philip. It's a productivity SaaS software company.
Yeah, look, Gnosis, for disclosure, I own this business at Merewether Capital and actually bought some after the last quarterly, just a little bit more of a top-up. I pronounce it Gnosis, Kochie.
Gnosis,
It doesn't really matter. Look, I think Phil sort of outlined a good point there. They did go into cash flow negative in this quarter, but that's more a reflection just on the lumpiness of their cash receipts. They've got a couple of big customers who provide their upfront annual subscriptions in the first quarter and the third quarter. So you see this natural lumpiness to receipts.
Right.
This business is actually similar to Quorum we discussed before. Bit of a turnaround. It's not the fastest growing business in the world. It's roughly break even, and because of that, trades very cheap on an ARR multiple basis. For me, I think there were some things to like in that last report, which is why I did do a little bit of a top up. Signed some new customers, grew their ARPU with their existing customers, showing some good traction with their product. I think they'll be roughly break even just because management sort of flagged they do want to invest to try and drive that little bit of growth. Yep. But look, they gave you 10% growth in recurring revenue quarter on quarter. That's pretty solid, and you need to see that continue for this share price to really re-rate. But it's one where I like the management team, and I know I'm there early, and sometimes being there early is no different to being wrong. It can play out that way, but it's one where I'm sort of backing this management team, and hopefully that growth trajectory can continue in the next few quarters. And
so you got it as a spec buy?
Re-rate. Definitely a spec buy, small position for Merewether Capital, so I wouldn't have it as a large one, but a nice little software business.
Claude, what do you reckon?
Yeah, I feel like this is definitely Luke's Coram, that you're early in the turnaround story. Look, I will say this one is a little cheaper than Coram, so potentially that's a positive there, and based on revenue, of course, I'm talking. But the other thing is that it's also less focused. So with Coram, it's more just about this healthcare software for pharmacies, whereas these guys have Green Orbit, Libero, and the knowledge management system, and they all have sort of slightly different style products, size of the product, cost of the product, and even though there's some commonalities, they're also different customers. So that's probably the disadvantage that turns me off it, and that's why I'm just a little bit less bullish on the stock than Luke is, and I don't own it, and I have it as a hold.
All right. Claude Walker from A Rich Life. Enjoy your weekend. Thanks for joining us on a Friday.
Thank you very much. It's great fun.
Luke Merewether, always great to have you aboard as well.
Thank you, Kochie.
Good on you guys. They're terrific, aren't they? Both of them. I love the way they analyse for different types of investors. Let's recap the final 5 stocks. Quorum, a hold from both. Delorean, a hold from Luke. It's on his watch list. A no from Claude. Sequoia, a yes from both of them. Firebrick, a no from both of them. And Gnosis, a spec buy from Luke and a hold from Claude. That's all we have for today. If you've got want us to cover any stocks you're interested in, put them in an email, the call at ausbiz.com.au, or tweet us using the @AusbizTV handle. Check out all the stocks in the calls portfolio at ausbiz.co/portfolio. Coming up next, don't go away, because on the small caps, we're chatting with Joshua Baker from Capital H Management and Stephen Hunt, the Executive Chairman of Spark Technologies. Spark looking to make its mark in the ultra-green hydrogen space and has just signed a deal with Fortescue Industries to make it happen. They're going to explain all of that. That's coming up next. You don't want to miss it.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Everyone who trades has a different style paired with a different strategy. So what do all traders have in common? Well, nobody gets it right 100% of the time. I used to be a trader, and for me the best chance of success comes from information. On The Trade, we delve into strategies, styles and skills of top traders. So join me live every weekday right here on ausbiz.
The Trade is brought to you by Markets.com. The world of financial markets, your way. Make the switch today.